So we are in QuickBooks Desktop Accountant 2022, and we're going to talk about the Accountant Center and the Client Data Review. So in the Accountant menu, you're going to see a option that says Accountant Center. It's the very first thing that shows up in the Accountant menu. Up here in the bottom, there's a little checkbox where you can choose to show that or not show that when the company file opens. So it's really up to you. The Accountant Center, in a nutshell, is basically a whole bunch of links to the accountant tools, or what would be shortcuts to the most commonly used tools that accountants use when they're reviewing a client's file. Now, you could use the Accountant Center if you own the file and you have it in your computer and you always access it all the time, or you can use Accountant Center if you're bringing in an accountant's copy or a client's copy or duplicate backup file or whatever of their file. So it doesn't matter what you're working on, as long as you own a license of the Accountant Edition, you should be able to see the Accountant Center. The only thing that's really sort of useful, in addition to the tools, all the tools at the top that are already accessible via the Accountant toolbar menu, it's right here, this reconciliation summary. So you'll be able to see what is the last reconciled balance of all the bank accounts, and this will quickly tell you and show you which accounts probably are not reconciled. So I'm going to show you the example right now. This is a sample file. So sample files never show the reconciliation right off the top. So I'm going to go ahead and reconcile the November 30th, 2023. I'm going to put 0 for a second here, and I'm just going to do a quick reconciliation for you, just so you can see, and I'll exclude a couple of checks here, and we'll put that 57,176.39 as the ending balance. So let's say that's the actual reconciliation that we're doing. I'll continue and finish that reconciliation. Click on Reconcile Now, and then once we go back into the Accountant Center, I'm going to go back here and go back and open the Accountant Center. And like I said, this is a sample file, so it contains those weird dates. You're going to see right there when the last reconciliation that was done, and you can click on that link and it will take you to the reconciliation report. So that's really the only place in QuickBooks where you sort of get a summary of all the bank accounts and the reconciled balances and the last amount that was reconciled. I kind of wish this existed in a report mode, but it doesn't. This is the only place where you can access that. Okay, so let's talk about the Client Data Review. This is the big one. This is the big change that they added, was it like 10 years ago? I don't remember exactly how far back they added this, which gave the accountants a whole slew of tools and workflow option to do the review of the client's QuickBooks Desktop files. So we're going to click on the Accountant menu, click on Client Data Review, and then click on Client Data Review. So the first thing that you need to do when you're doing a Client Data Review, and I'll expand this screen a little bit, first thing, the most important first thing, is you have to click on Modify Review and then choose what is the review period that you're working on. So typically this is going to be year to year for a tax return or whatever. So you're going to pick your review period. So let's say we're going to review 2021, and then we're going to pick whether the review is based on accrual basis or cash basis. It's up to you. Typically I do all my reviews in accrual no matter what, and then I do journal entries to do a cash accrual conversion. That might be a topic for a different webinar on why I do that and how I do that. But you will pick the way you're going to do it. You're going to pick whether it's cash or accrual, and typically you want to be consistent every year. So we're going to click on accrual, click on Modify Review, and then that's set up. So now that it's officially set up, you're going to go through all the different tools that you have here, and you're going to see a little icon. It's a little yellow wrench icon, letting you know that that's a only an Accountant Edition tool, something you can only get through the Accountant Edition or the Client Data Review. So for example, you can look at a working trial balance without having the Accountant Edition. That's just an example, right? So that's really what it means. So next to all those things, you're going to see those tools. Only accountants have access to that. Okay, so let's say you're going to do any of those actions. For example, let's say I'm going to review my chart of accounts, and if I click on that, it sends me to a list of changes that were done in the chart of accounts. So for example, we did a review period, and then once you open this again in the future and you do another review period, you will know anytime somebody makes a change into accounts. So I'm going to show you, this might not show up because it's not in the current period, but I'm going to go into chart of accounts and I'm going to merge two accounts, and we'll just check to see if it shows up. So let's say I'm going to mix dues and subscriptions and union dues. So I'm going to come in here, change the account number to match the other one. So 500, then click on save and close. Then it's going to say, would you like to merge these? We're going to hit yes. Again, I'm not recommending you do this. I'm doing it just to show you what are the type of things that would show up in here. So right here it says, look, from the last review that you did, you've made a change, or anyone rather has made a change and has merged to account. So if you make a change to an account, delete an account, create an account, that's all going to show up in here. So that's really important thing. This checkbox that says include reviewed items, that's for items you have reviewed in the past. So once you look at all of these, you can, once you're done reviewing your item list and your fixed assets and your payroll items and all that stuff, you're going through the process of making sure that you understand the changes, agree with the changes, and understand the consequences that the changes are having to your financial statements. You're going to click here where it says mark all as reviewed, and it basically completes sort of that task. So once you're done with that, here in the chart of accounts, you can choose whether it's in progress or completed. You can put here completed, and then you can add task notes. You can see, you can type here dues and union dues was merged, not affecting net income. Whatever note you want to add to that. Okay, so then you have basically your task notes. So you add individual notes to those tasks. You can also do high-level review notes, like pending loan statements, something like that, right? Whatever it is. And then once you get the loan statements, you go back and change those notes. Again, it's just a really simple place where you can just keep track of doing your review, and you can look at the notes at the task level and at the entire process level. Now we're going to talk about some of these tools a little bit later on. We're actually going to show you how some of these tools work, but I wanted to make sure you understand what is the concept of using the client data review. Now there's also a really cool thing here, which is a print button, which basically it lets you print out. You just click print again. It lets you print out what that screen looks like, all your tasks, the statuses, and the notes next to them. So if you want to have that in the client file, you can also save that as a PDF. That's also an option, saving that as a PDF if you want to. And then there's an audit trail of the review, which basically tells you all the things that were changed once the review was started. Then you can mark the review as completed, and then you literally complete your entire work, and then print your financial statements, prepare your tax return, whatever the next step is at this point. Okay, so that's the client data review. Let me go ahead and click on close. And then the next thing we're going to talk about is troubleshooting prior account balances. This is one of the tools inside the client data review. I'm going to click on accountant, client data review, and then we're going to see where it says, where are we? Prior balances. Okay, it's not here on this screen. Let me go back to client data review, and that should be right here, the very first tool. That's kind of strange that that's not in there. So it's one of the weird, quirky things that beginning balances option is not right there in the client data review. So I'm going to click on troubleshoot prior account balances. This is basically letting me know, hey, this tool is designed for you to make adjustments to your balance sheet in a high level. So for example, let's say that I want to review my books as of a specific beginning date. And in this particular case, it's a really good example. When I run a balance sheet for, let's say, 12/31/2020, I'm missing information. This is typical for when people start using QuickBooks for the very first time, and they have a beginning balance that they're supposed to have in there. So whether you have already numbers there or you have missing numbers, this is a tool where you can quickly enter your beginning balances. So you're going to pull up your maybe your Schedule L from your tax return or your previous balance sheet, and you're going to go in there and you're going to construct your balance sheet. So in this particular case, there's already 0 beginning balances, so I'm just going to construct it from scratch. So I'm going to put here all the dollar amounts that are supposed to be here. So again, we're copying this from whatever our official balance sheet is, and I'm just putting numbers here at random. So I want to show you kind of what this looks like. And then we go out in our liabilities, and let's say we have here 60,000 and 35,000, and there's all sorts of nuances to when you do this, what happens when you do this, because for example, inventory, accounts receivable, and accounts payable should actually be done at the item level, at the customer level, at the vendor level. In either case, I'm letting you know how this tool works. I mean, those things you're gonna have to explore more deeply. So I guess this is the beginning balance sheet that I'm supposed to have. And then once I'm done doing that, I'm gonna click on View Suggested Adjustments. QuickBooks will now generate a journal entry for me. One thing that's really, really important, really super duper important is normally, if you're gonna adjust AR and AP, or AR and sales tax payable, AR or payroll tax payable, or AP and payroll tax payable, or sales tax payable, or accounts payable. So AR, AP, accounts payable, sales tax payable. These are protected accounts that require a vendor name next to them in order for the journal entry to get executed. So it is possible that you might be doing this in multiple instances. Do all your assets first, then do all your liabilities second. That's a possibility. At the end of the day, this balance sheet is going to be on balance, right? Or this journal entry is going to be on balance. It would be your responsibility to choose where you're going to put that balance entry or that difference. So typically it's going to be retained earnings, and we can have a really long, nuanced discussion as of should it be retained earnings or something else. Doesn't really matter. But normally the default is retained earnings. You would do that, and if I click on Save, it won't let me because I have accounts payable. So you have to make sure that if you have accounts payable, you have to put the vendor's name. If it's multiple vendors' name, then you need to skip using accounts, at least accounts payable in this tool, and then you're gonna have to enter the vendor balances one by one. Again, that should be covered probably in a different course altogether. So in this one, I'm just gonna call it 2020 AP balance. I'm just gonna create a generic vendor for this. This is a typical thing that we do when we do tax returns, where we have a balance sheet, we have no idea who the vendor is, we just create a bogus vendor, and then we adjust that afterwards. So we're going to do that, click on Save, and then once we do that, it gives you an option to reverse the journal entry. For this particular situation, I'm not going to reverse it, but it does prompt you to do that. There are reasons when you have to, reasons where you don't. Okay, for right now, I'm not going to reverse it, and I'm going to go back and run my balance sheet for 12/31/2020, and then you're going to see your balance sheet that was previously blank. So it gives you a general idea how that troubleshooting prior year balances work. Now what I'll do is I'm going to change the period here. I'm going to show you 2021. That way you can see what it looks like when there's already numbers in there. So let's say, for example, I'm now going to troubleshoot a year that actually contains already a balance sheet. So let me go ahead and pull up the balance sheet to add some context to this. So let me run the 2021 balance sheet and just assume for a minute that you're going to do a review on 2022. So what you're looking at is you're looking at the 2021 balance sheet and you want to make adjustments. So for example, let's say that this checking balance really should be 103,200 and it says 74,000 for some reason. So you're going to come in here and you're going to make the difference. So 103,200 we said minus 74,343.03. So now what you get to see is you get to see the current balance in QuickBooks, you get to see the debit, the difference, and then you get to see how much the adjustment is. As a matter of fact, sorry, I made a mistake. In this first column, we don't make that manual calculation. That was my mistake. You only put the dollar amount. Sorry, I'm just used to doing journal entries so much that I forget about that. So in here, you're just going to put the true ending balance. So you come in here and put the actual ending balance, and then QuickBooks will generate, you can see that very clearly, it will generate those differences. Okay, if I double click on those differences, it takes me to an audit trail. No need to look at that at the beginning. At this point, all you're going to do is see what the differences are, and then we go to view suggested adjustments. It creates the journal entry. The journal entry, of course, is unbalanced, and at that point, I choose what account I'm going to send that difference. So if I'm going to send it to an income account, an expense account, retained earnings, that's more of an accounting question, and probably too much to cover in this particular webinar. Okay, so that's troubleshooting prior year balances. I absolutely love this tool, especially during tax season with brand new customers, where they send me this massive and messy, super messy QuickBooks desktop files, and I just want to match the last year's balances with the tax return, probably reverse the entry, and then move on, that sort of thing. Let's move on to the working trial balance and the adjusting journal entry. It's actually pretty interesting. So I'm going to go ahead and run a trial balance report. So I'm going to go to reports. I'm going to go to accountant and taxes, and then run a trial balance. So I'm going to do trial balance, let's say for last year, last fiscal year. I'm going to put it up here on the screen. Then I'm going to go to reports, accountant and taxes, and then I'm going to go to adjusting journal entries. I'm going to show you that. Okay, that way you can see what the adjusting journal entries here. I'm going to go to last fiscal year in this specific case. And once we're in last fiscal year, we're matching these. And then we can see that there is one adjusting journal entry. Now, what the heck is an adjusting journal entry? Well, it's a journal entry that has a checkbox on it that says adjusting. Now, most people are perplexed and mesmerized of what is the point of that checkbox. And believe it or not, there was a point to the checkbox. There is a point to the checkbox. The point of the checkbox is to differentiate what is a routine, normal accounting journal entry and what is an adjusting journal entry. So typically, the adjusting journal entries are going to be reserved for the accountant. It should only be sort of the accountant, the auditor that makes that sort of work. The end user, the small business owner, should be doing just regular journal entries, not adjusting journal entries. So you can differentiate the work of one versus the other. So now that you can see that there's a $44,000 journal entry here, basically what this is telling you here is that at the end of the day, when we look at this specific account, let's see which one is it? Is it depreciation expense? So let's go down here to depreciation expense. Notice that depreciation expense here is $44,000. That's run by one adjusting entry. I'm going to do a second one just for the heck of it. So I'm going to go to duplicate here, and I'm going to do here 21,500, and also do 21,500. So I'm essentially doing two adjusting entries during the same period, and I'm going to click on save. We see total depreciation expense of 65,000, and when I go back into this report, the adjusting journal entries report, we see exactly where that 65,000 came from. It came from these two adjusting journal entries. So there's a couple of interesting things that could be done here. First thing I'm going to do is I'm going to run an adjusting journal entry report, an adjusted trial balance report. We already did the adjusted journal entry. We're going to click adjusted trial balance. I'm going to go ahead and close that report, and I'm going to do here last fiscal year, and I'll just put these two sort of next to each other. Okay, so these are essentially the exact same trial balances. If I go all the way down, and if we look at the total debits and total credits, which is this last column in the adjusted journal entry, is the exact same. However, on the adjusted trial balance report, you get to see the first two columns, which is called unadjusted balance. Then you see adjustments, which you see right here, 65,000. And if I click on the 65,000, essentially it gives me a report of all the adjusting entries, which is pretty interesting. If I go to customize report and filters, it doesn't show it here, but usually there is a filter here called is adjustment. So if you want to run your own report of journal entries, you can do that by going into is adjustment and click on yes, and that will get you that. This report didn't show that filter because it was created from the adjusted trial balance report. But if you ever need to or want to do that, if you ever want to run a journal entry report and you want to know whether or not they have that adjuster property in it, which is this little checkbox that you see right there on the fourth column of the report, you can run that filter. So where could that be useful? Well, maybe, possibly, I want to know what my trial balance looked like prior to my journal entries. And then after, maybe you want to show the small business owner or the client or whatever, hey, this is what it looked like prior. This is what we changed. This is what the result of our work, of our review, basically did that. Okay, so that's pretty much it. So that's what that's for. Now, some people find that useful. Some people not so much. Would love to know what you think. I mean, I find it really useful. I don't use it a lot, but I do find that useful, especially when I want to see those two things. Now, one thing that I want to show you, it's kind of an interesting thing. I'm going to run a profit and loss report, profit and loss standard for 2022. And this is something I'm sort of improvising right now. I don't remember if this actually worked or before or not. So we're going to give this a shot really, really quick. So I'm going to click on so I'm looking at a profit and loss. I'm going to click on customize report. I'm going to click on filters. I'm going to click on is adjustment. And then I'm going to click no. I want to see what happens if I do that. And I click yes. Okay. That actually did exactly what I wanted it to do. So if you want to see what your profit and loss looks like prior to those adjusting journal entries, all you have to do is run a profit and loss. Again, we click on customize report, click on filter, and then go to is adjustment and click no. What a beautiful thing. I can literally run a P&L prior to adjusting journal entries. And then if I add my journal entries again, I'm going to go to filters and then go to is adjustment and click on either and then click on OK. Then I get to see what my profit and loss looks like, including that depreciation expense. So if some people are sort of shocked by looking at the P&L with a negative amount because they weren't expecting this adjustment of depreciation or whatever, you can show people what that looks like prior to that journal entry. You do need to make sure that if you are going to go this route of pulling a P&L and getting rid of those adjusting entries, you want to make sure that you go back and run that report. Go to reports, go to accounting and taxes, and go to your adjusting journal entries, and make sure that whatever journal entries are there are the official accountant adjustments, the QuickBooks versus tax return adjustments, the business owner's version versus the accountant's versions adjustments. So if you are going to go through that process of pulling a P&L without that adjusting journal entry, you want to make sure that all these journal entries are what they're supposed to be to make sure there's no confusion when you run those P&L reports. Awesome. Let's talk about the next tool, which is called the Merge Vendor tool. Now, unfortunately, the QuickBooks employee that developed this add-on no longer works for QuickBooks, and they can't corroborate this. But I consider myself one of the inventors of this tool. This was in my wish list for many, many, many years. It wasn't executed exactly how I wanted it, but I think they at least solved a lot of the stuff that I wanted. And what this solves is the issue where maybe you got 27 Home Depots, each one with a store number next to it, or 17 Chevrons, everyone with a store number next to it, or maybe a whole bunch of McDonald's or whatever. So again, at the end, you have a lot of the same vendor that are essentially duplicate vendors, and you want to quickly merge them together because it takes forever for you to go to every transaction and change the vendor to the one vendor that you want. So I'll just give you a quick example here. I'm going to go in there and create a bunch of chevrons. I'm going to go to vendors, and I'm going to go to unsaved vendors. And again, I'm just going to simulate the fact that we have a whole bunch of the same vendor essentially duplicated. So let me just go in there and create chevron, and I'll do a whole bunch here. So let's say we have a whole bunch of chevrons in our QuickBooks file. Again, every time it was brought in, the user didn't realize that this was happening. And I'll go ahead and just enter a couple of transactions to a different one. So let's say $50 and auto, and I'm gonna go save, and then I'll do a new one and pick a different chevron, $75 and auto. And again, I'm just gonna show you why this could be a potential issue. Although they're just sitting on your vendor list, you probably they don't bother you. But if you ever run a profit and loss, not profit and loss, a expenses by vendor report. So you're going to company and financial and do expenses by vendor report. And we go down and take a look at Chevron, you're going to get really annoyed by having the same vendor listed a whole bunch of times just because the person doing the data entry was kind of careless about that. So this is what I love about the vendor merge tool, which allows you to just really, really quickly merge all those vendors. Now, there's a restriction to the merge tool, which is it can only do 4 at a time. So I'm going to pick 1, 2, 3, 4. And that's the part where I said I'm a little disappointed on how it was executed. I wish you could do more than 4 at a time, but this is the restriction that they made. And I explain why they made that restriction. Because on the next screen, it shows you the 4 columns. And when they built this tool, they were thinking of a vendor that you actually use for accounts payables, where you have bills and payments, and merging vendors with bills and payments could create a big mess. And maybe they have different contact information or different addresses. So you want to keep which one is the sort of the true one, the one that contains or brings all the, or should keep all the right information, name, address, that sort of thing. So you get to pick which is going to be the true one, the ones that they're going to be merged into. And then you have 2 buttons. You have backup and merge, which I like, nice touch, backup before you merge, or a quick merge button, which basically wants you saying, are you sure? Because you can't really undo merges. And then you say, yeah, sure, I know what I'm doing. You do the merge, and boom, all of a sudden, you have less chevron. Same thing. I'm going to go do this, go to next, pick one, and then go to merge, and yes. Okay, and then you can start merging. And then at some point, once we catch the one chevron, the second one that I use, we should no longer have multiple chevron. Actually, let me skip the backup. Chevron vendors. So let's try that. So now I'm going to go back to my report, my expenses by vendor summary, and then we see we only got one chevron that adds up the 2 transaction amounts. And then at that point, once all that stuff is done, I can go into my vendor center, look for the one chevron that I want to keep, and then just remove the numbers or whatever, and chevron oil or whatever I want to call it. Okay, so I give it the official name, and that becomes the official vendor name. And then when I look at my report, like expenses by vendor report, I got everything merged in there. So again, I love the tool. I wish you could do more than 4 at a time, but that's how it is. The tool does not have the ability to merge customers or the ability to merge other names. Now, if you have something set up in other name, and I'll show you this really quick. So let's say, for example, I'm going to create, I'll just do a check really quick. So write a check, and we'll select, say, this one, and this check is $600. Actually, I'm going to create a new vendor. I'm going to call it Florida Telephone. And then when I create it, instead of creating it as a vendor, I'm going to create it as an other. That's possible. That happens. And I'm a big not fan of that, but you can create it as another. That is possible. So you can actually take that other and bring it to a vendor and then merge it afterwards. You can merge others. You can only merge vendors. But if you want to merge an other with a vendor, this is how you do it. And again, you cannot merge an employee with a vendor. If you created something as an employee, that's it. It'll stick as an employee. But here under company, and I don't remember exactly where it is, or maybe under list, and under, I believe it's other names list. Yep, other names list. You have your other names list, and then if you want to convert that one to a vendor, you're going to have a little button here. Actually, it should be under activities, maybe right here. Under activities, it says change other name types. And then you get this window that says change other name types, and then I can choose which ones I want to change over. So I want to change this Florida telephone to vendor, and I want to change Tom Ferguson to vendor, or whatever it is, and then click on OK, and that will convert them to vendor. They cannot be sent back to other. They can only be sent to vendor, and then you can merge it at that point. Okay. Okay. Next topic we're going to talk about is writing off invoices versus doing a journal entry to write off invoices. So, for example, I'm going to go ahead and run a balance sheet up to 12/31/2021, and then we have some accounts receivable in there. So there are two ways to sort of clean up or get rid of some of these accounts receivable. So I'm going to leave the balance sheet up in the screen here, and I'm just going to show you a typical thing that people do when they write off invoices. We're going to go into an AR aging summary, and then we're going to go to 12/31/2021, which is the one that we're writing off. And then we're going to go through and take a look at which ARs are problematic or potentially problematic. So typically, when we do something like this, we're going to be focused on invoices that are old, that are not current. So right now, none of them are showing current. What I'm going to do is I'm going to grab one of them and modify the terms. I'm going to put that to do on receipt, and then maybe bring this back to July 15th, 2021, and then click on OK. And this one happens to be paid. So what I'm also going to do is just for the example's sake, I'm going to delete this payment, and let's say that we never got the money for this invoice. So I'm going to go ahead and just delete the payment, delete the deposit. Again, I'm just going to simulate us wanting to write off an invoice. Okay, so we're sitting here, we're looking at our AR report, we're looking at $14,000 that we want to write off because we're never going to collect this. So there's essentially two ways to do this. One, you can use the write-off tool, or two, you can do this via a journal entry. And you can also do this manually via the discount tool, or you can do it via a manual credit memo. There's actually more than one way to write off an invoice. But the most typical things that accountants do is they just write off via a journal entry. That is possible. You can do that. The journal entry write-off, the way it will work is you go into company, you're going to make general journal entry, then you pick the date of your write-off, 12/31/2021. Then we're going to pick accounts receivable as the first account. I typically like using accounts receivable as the first account. I'll make this journal entry a little bit smaller so it's easier to read. And then we're going to credit, or whatever the site is, depending on the balance, the amount. Then, very important, on their name, we need to make sure we pick that customer's name, basement remodel. So we're going to pick their basement remodel. So we pick the specific customer. If you don't do that, it won't work. It won't let you save something to accounts receivable. Also, in a journal entry, you cannot do more than one. So you can only do one at a time. Then we're going to do this against sales, or maybe construction income, or whatever income account is. It's one of the approaches. Some people, when they write off against an income account. Other people say, oh, that's a sacrilege. You should never be writing off against an income account. You should be using a bad debt account, which I think is probably the best bet. So a bad debt expense account is probably the best one to use. So we'll put here bad debt. So we got a bad debt expense account, good. And then write off against that. So that's step one. We just write off in a journal entry. I'm going to click on save. I go back to my AR aging report, and I think I used the wrong customer, of course. So it was supposed to be, which one is it supposed to be? It's supposed to be Johnny Melton, not Annabelle Vasquez. So just making sure you're paying attention. So we'll do Johnny Melton. Okay, there you go, Johnny Melton, and the specific job. Click on save. Yep. Okay, perfect. And now you're going to see AR is 0, but you see a negative under current and then a positive on the 90 plus. That's an issue. And the reason for that is because these have not been applied yet. So the way you apply a payment into an invoice, and there's two ways to do it. One, we can open the original invoice once we know that we've written it off, And we can go up here where it says refund and credit. We can click on that. Whoops, not there. Sorry, that wasn't the right one. It was supposed to be applied credits. So sorry about that. Applied credit, refund credit is a different approach. Then we're gonna go to applied credits. We're gonna select that journal entry. We're gonna put a check mark next to the journal entry. Then click on done. And then the invoice shows paid, which is a little bit counterintuitive because that invoice was never paid. But in QuickBooks, a paid invoice, it's an invoice that doesn't have an open balance. It doesn't literally mean it's been paid. And you won't know that this has been paid unless you actually save this transaction, go to Control H on the keyboard, and see that it's adjusted against the journal entry. So typically what I do when I do that, I go into the memo and put written off 12/31, 2021. So I typically go back and put that memo in there to just kind of remind me that this invoice has been written off. It's just something that allows me to understand that this is truly not a paid invoice. It's a written off invoice. So that's one option. That's one way to write off the invoice with a journal entry. The other option is, and I'm going to go ahead and delete that journal entry because we already did that example. So go to delete. So the other option is what I had pressed at the beginning, which is refund and credit, where you click on the invoice, click on refund and credit, then select the date in which you want to write this off. Okay. And one thing, if you write off using that button, it's actually going to replicate every single line item, typically reversing that income. So if you want to reverse the income that was originally posted to, then you use that option. If you don't want to reverse the income, what you could do is delete all these things in here and then have a generic item for the write-offs. I'm going to put here write-off. So I'm literally just creating an item called write-off that's going to go into bad debt. Click OK. And then I put that dollar amount, which is 14,488.64. I'll make sure I don't apply tax to this one. And I can hit save. And then once I do that, I apply that to an invoice. Click OK. Click on done. And that's it. That does that. Now there's some caveats to that. This is a bad idea if there's sales tax in the invoice and you want to get a credit on that sales tax, assuming you're an accrual sales tax payer where you already paid that sales tax in a previous form. So if you want to do that, if that's your goal to do that, then what you might want to do is, and whoops, I put the wrong dollar amount here, 14,488.64. Hit save again and apply that to the invoice. So I didn't do the example correctly. So if you want to reverse that sales tax effect, what you could do is remove that amount from the total. So I'm going to remove the sales tax amount from the total and still be able to do the bad debt thing, negative 158.14. Then make this a taxable transaction. And then essentially, let me do it again, 14,488.64 minus 158.14. Okay, you make that taxable transaction, and then just ignore a remaining credit here for a second. And actually, some of these things were taxable. It looks like okay, so only part of this was taxable. So then, what I would need to do is I need to literally figure out what part was taxable and untaxable, and split this into two items. It does get a lot more confusing when that happens, but just keep that in mind. If you're gonna write off something with sales tax, you might have to sit down and break those up with the taxable and non-taxable in order for it to work. So I'm going to close that. In my opinion, and let me delete that credit. In my opinion, if you got something with sales tax, you should always use this technique, the refund and credit technique, and then refund the actual items that weren't paid for, if it's not all of them, in order to do the write-off. So again, that sales tax throws a huge wrench into the mix. If it's a non-sales tax issue, you can just use the journal entry. Okay, so that whole setup was then to talk about why would you use the write-off tool. If you know how to do it manually, why would you use the write-off tool? Well, it's because you can do more than one transaction at the time. So what I'll do is I'm just gonna duplicate this invoice for a minute. Let me duplicate it, and I'll pick a different customer. I'll just change a couple dollar amounts here. Okay. And let's say this is 6/1/2021. I'll save and close. So now I have multiple, a way I can illustrate the point. Okay, so I'm going to have multiple, essentially multiple invoices to write off. So I'm going to go to the accountant menu, go to client data review, and then click on write off invoices. Write off invoices. Then I'm going to pick the period. So let's say 12/31/2021. I'm going to pick how old the invoices are. So depending on the review period. So for example, let me open up this invoice, and I'm going to make it not that old. I'm going to make this, let's say, November. Okay, that way it gets make a little bit better point here. So it's a November one. So once, depending on what I choose here, what the review period is, let me do 12/31/2021. So depending on what the review period is, it will filter out some of these potential invoices that I want to write off. So that it's just a tool for you to know which are the invoices that I want to write off at this point. Now these are made based on today's date, but you can do review period and then figure out which are the ones you're going to write off. So this allows you here by age, you know how old they are based on whatever today's date is, and then you pick all the ones that you're going to write off. Once you pick the ones you're going to write off, here where it says write off item, that's where you're going to pick. I think I created a write off tool, a write off item. So write off, there you go. And that write off item is going to hit the bad debt account. And then I click on preview and write off. It's pretty good. And the write off date. I go preview and write off. And then this will come in there, give you a quick preview, click on write off, and this is going to create those credit memos for you. So once you see those credit memos be created for you, and let me open up, do you remember which was that customer? I don't remember which was the customer. Let me just pull it up here real quick, and we'll pull up transactions, we'll do credit memos, and then we'll do let's do all dates, all credit memos, and it's this one right here. So this credit memo was created, okay? And notice that it takes every single line of the invoice. It picks which one's taxable and which one is not, which is one of the things that makes that whole sales tax process a lot easier. But it overrides the item and uses the item write-off so it can send the stuff to bad debt. So now when I go back into my profit and loss report and I pull up my profit and loss report for 2021, I believe was the period that we used, I should have a bad debt expense account for $68,000. Double click on that, and there are my credit memos that we use to adjust invoices. All right, it's awesome. Okay, so the very last thing we're going to talk about here before we wrap up today is this option of fix unapplied customer payments and fix unapplied vendor payments. So for example, I'm going to go here to accountant. I'm going to go to client data review, and then I'm going to look for fix unapplied customer payments and credits. Okay, so I don't have any unapplied customer payments right now. I'm going to go into customers. I'm going to grab any of my payments that I have here from 2021. Let's do all dates here. Okay, so there isn't any right now, but it will be all periods, so it's okay. So I'm going to grab this customer payment here, and I'm going to unapply it. So notice that all I'm doing is I'm unapplying, and click on save and close. So once I unapply, and let me pick another one here, and I'll unapply that as well. So once I have payments that are unapplied, and I go back into that screen, I'm now going to have a list of all the customers that have unapplied payments. Now it's possible that the customer balances are zero. They're not showing balances because there's a negative and a positive adjusting that AR. Okay, but this gives me a quick way to quickly in batch apply all these things. Now typically it only really works on accrual basis or cash basis. It's a really bad idea for dealing with this type of thing. So when you're on accrual basis, that's when this type of stuff works and makes sense. Okay, so we're gonna go ahead and pick the payment and the invoice together. You're able to see the $2 amounts match. I can click on apply, and that applies that. Okay, and then I go to the next one. Okay, and then I can click on save, done. Then I go to the next one, apply and apply, and then click on save. And there you go. All my unapplied payments are set. Unapplied vendors is a little bit different, and this is a kind of an interesting thing. Unapplied vendor actually payments works with both unapplied accounts payables and checks that were used outside of the bill payment system. What do I mean by that? Let's say, for example, I'll create a bill. I'll create a bill for this vendor here. Let's say Chevron. And I'll create a bill for $150. Okay, and I'll just date a little bit earlier, and let's say this is gas. Okay, and I'll click on save. Okay, good. I got my bill. Now, generally, I should be doing a bill payment. I should be doing an actual bill payment. But let's say I made a mistake and I didn't do a bill payment. I went into write check, and I went into that Chevron, and then I ignored this whole concept of pay bills, and I went to write check. This happens a lot when we're cleaning up QuickBooks files. This happens to me quite a bit, where basically the expense has officially been duplicated. If I go to reports and I pick, let's say I pick that account, the gas and electric account, we're going to see that $150 for Chevron was essentially duplicated because I was careless. I created a bill and also a check for the same transaction. So one thing that's really, really cool about this tool that fixes unapplied vendor credits, payments and credits, is you can actually grab a check that was meant to be a bill payment, select it, and then click on apply and click on save. And essentially, I'm going to just do a quick search for that payment. I'm going to go into that payment for $150. And essentially what it does is, it wasn't, not the bill payment right here. Basically, no, it wasn't that one. Where's the check? Oh, here it is. So basically grabs the original check, changes the underlying account to accounts payable, which is how we fix checks that are wrongly applied to an expense instead of a bill, selects Chevron, and also, like the Control H on the keyboard, it links it. So it actually marks the bill paid to make sure that that check is actually linked properly with that bill. So the tool is truly, truly amazing. It's a great tool to use. Okay,